Hello, everybody. Thank you for joining us for today's public webinar. It's been a while. Did you miss us? I think we missed you guys a bit. Hope you all had a wonderful Thanksgiving, also for those of you in the U.S. Good morning, Jim.
Good morning. Good morning. It's not as good as it sounds like. I figured out it's gotten a little cool out here. I turned the heat on, but it's not working. So I'm a little chilly this morning. Okay. What I've got up is the SPY chart. And one of the reasons that I like the SPY is it is such an efficient market and the volume is so heavy. But the first thing you see by looking at the graph is notice, well, I think this is like 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9. For 10 days, it almost perfectly fits a line. When you see something like that, that is nothing more than weak hands, short-term traders. That's how they trade, looking for very mechanical places to enter and exit the market. So this tells me that this particular rally is late in the rally. It tells me that the danger is very great to the long side. And remember, if you looked at our week ahead piece over the weekend, that was before it broke this trend line. But this is what I used over the weekend. And so the danger of being long is very, very high. So you see what happens. We come into the week and we get the downside. We get a downside breakout. And what happens when the market goes like this and it perfectly fits this line, there's going to be stops after any of these. And so you see when you hit this, you're going to get a tremendous number of stops. So what's happened in there? The market has gotten very long and very long in weak hands. Then you get a liquidating break. And when the liquidating break comes, it starts to trigger all these stops, and then short-term traders jump on the short side. Then, as you saw yesterday, it went from one extreme to the other. It went from, and let me go to yesterday's profile. So the market, it just got ridiculously short. Everybody jumped on it because it's all weak hands traders. The larger money has packed it in for the year. They've either had a good year or a back year. So then we got inventory was too long, then inventory gets too short, then short-term traders go crazy, and everybody jumps on board again, and they follow the market and take the market all the way back up, almost to the trend line. And then what have you had overnight? You've had this liquidation again, late yesterday afternoon and overnight. So the danger in this market is it is almost 100% short-term traders. And the nature of short-term traders is, and I've said this so many times, it's hard to even say, but it's the herd instinct. Everybody jumps on board. You can see yesterday, all of a sudden, the number wasn't any great number, but that was enough to start the short covering rally. And then it feeds on itself, and they go from too short, feeds on itself, to too long, and then you take this all back overnight. So the danger in this time of year, remember, the majority of the bigger money, they packed it in for the year. They've either had a good year or a back year or a bad year. They're not going to make a lot of changes this late in the year. But you have a lot of short-term traders out there, and it just gives you an extremely dangerous market. I mean, I don't have a lot to offer other than that. But so much of short-term trading is dependent on inventory constantly getting too long and too short. And it's understanding the nature of your competition. For example, when I showed you the bar chart here, this was just mechanical trading for 10 days, bought the trend line. Very, very mechanical trading. This is not the activity of stronger money. This exactness is the activity of very short-term traders because they can calculate this line. Then you get the liquidation. You notice yesterday, and it takes it almost back up to the line, and then they sell it off again. All right, I mean, I don't have anything really intelligent to offer other than how dangerous these markets can be in here. And today we're gonna open, and we've got about 20 minutes, and we're down near yesterday's low. So we're gonna be in the middle of about a 3-day, 4-day range. Let's take some questions.
Okay, let me go to our website real quick. Let me take the screen back from you real quick. Okay, can you see my screen?
I certainly can.
Okay, for those of you that are new or maybe not as familiar with us, if you haven't signed up for our emails to get announcements, sometimes, we offer a free report or, class announcements, more book information, like we've received so many people writing in asking about when Jim's new book is going to be available. You can sign up for our emails here on our homepage. Go to jimdaltontrading.com, and in this black strip here, you can subscribe here. But make sure that you respond to the confirmation email, because until you do that step and confirm that you want to join our email list, you will not be subscribed. And there's plenty of folks who do this step and then they don't do the confirmation. Jim's new book is available for pre-order. You can go to our website resources and go to the books link and see all of our suggested books here for reading that we feel are very relevant to trading and to things like mindset and working on your self-understanding, which is also a large part of the journey. But you can see here that the book is available for pre-order here. It is to be deliverable by February 11th. Is the information that the publisher has given us thus far. So you can find the book here on our website. Really exciting. Hope you guys all check it out. I'm getting a lot of questions about other countries. When will it be available in other countries? That's up to the publisher. So unfortunately, I don't have a solid answer for you on that for those of you outside of the US. I apologize about that.
Well, I don't know.
But
How does it work? I mean, you order it on Amazon. I don't know how it works when you order on Amazon from other
oh
countries.
well, within the US, obviously it'll be deliverable by February 11th. For other countries, it's about when they have that available, or the publisher makes it available for publishing in those other countries. So that's out of our hands. So if you got any friends coming to the US that can order it, get you a copy and bring it back to you, that's another way to think of it too. If
Well,
anybody's
I'm not
coming.
sure that's a right answer. I mean, I don't know how Amazon. You can order from any place in the world from Amazon, can't you?
You can, but not all items are going to be available, Jim. It's
Oh,
it's
okay.
often very regional. So
Okay. I don't know how they
um,
ship.
yeah, another person here said Amazon in other countries catches up almost immediately. So maybe it won't be too much of an extra wait for other countries. So yeah, they do. Amazon does deliver worldwide, but I think it'll depend on, like, say, in Europe, when will the book be available there. I mean, I'm sure if you're in Europe and you have Amazon, and if it's not available right in your country, if Amazon's not in your country, then you can still order it. Like I know in Portugal, for example, they order from Amazon Spain, for example. So another person confirmed I ordered it in Poland, no problem. Thank you for letting us know that. It's great for other folks who are in that region or in that country who may be interested and are wondering. Okay, so Jim, back to you. You want me to give you back the screen?
Sure, just questions. What kind of questions we got?
Okay. Somebody's asking, when will we know that it's time to get out of long-term positions? Let me give you the screen back, Jim, so that if you're pointing to anything, everybody will be able to see that. I've given you the screen back.
When I hear a question like that, you know, if you have to ask that question, I'm not sure you should be in anyhow. You know, what is long-term position? Everybody's got a different definition of what is long-term position. So I mean, I can't answer that question because there is no definition to that question. If you're, you know, intermediate, when you look at this, when I showed you the chart up here earlier, when you look at this market, I mean, this tells you that the risk, when the market's this mechanical, the risk of being long is huge. Now, understand the difficulty of that question. The majority of people that manage their own money on a long-term basis underperform the professional money managers by about 40%. The professional money managers basically stay fully invested most of the time. I mean, big cash positions may only be 3 or 4% for a big long-term money manager. What happens when people get in and out of the market on their own for long-term positions, whatever that means to everyone? The problem is they don't get back in. And they usually, because the news is bad, when the markets are making lows, the news is pretty bad. And that's when you come in to enter the market. And most people can't bring themselves to do that. And that's why the long-term money managers that stayed fairly well fully invested, the typical answer, people say, well, why should I pay them a fee? They're not beating the market. Well, and that's right. I mean, they don't greatly outdo the market. However, they do greatly outperform the individuals because the individuals are in and out of the market. They get out of the market and they don't get back in until the market's way up. And there's about a 40% lack of participation there. It's just the long-term nature of things. I mean, I tell the story. I was part of the original going public for McDonald's. And, you know, after I was 7 times on my money, I got out. And of course, you know, see how many millions of dollars that's cost me over the years. But it was that time I was very young, and really didn't appreciate what long-term investing was all about. Okay, what other questions?
Okay, is there a particular day or date that big money typically stops trading at the end of the year?
No, it's just that, and I'm sorry to sound this way, but that's another question that just shows a lack of really any appreciation or understanding of how the market really works. I mean, that's like looking for the magic of when they're going to stop. There just isn't. There isn't an answer to a question like that. And even thinking that there's an answer to a question like that is problematic and shows somewhat of not an appreciation for how markets really work. I don't mean that to be condescending. It's just so many times short-term traders don't appreciate the whole difference between what they do and what the longer-term money managers do. I mean, Warren Buffett, I mean, that's taking one extreme, but I mean, he's been in some of these positions for years. Now, people are questioning right now with all of the liquidation that he's been doing, is this a sign of a problem in the market? Well, who knows? But I mean, think how many years he's held a lot of those positions. Okay, what else?
Okay. You've said that big money takes positions 2 to 3 days before a big report or event. How does this reflect in tempo? And another question is the current all-time high, it's a poor high made in regular trading hours. What are your thoughts on this?
Well, it's the same thing I always say, the odds are against a lasting all-time high being made during extended hours trading or during the, can it happen? There's nothing that says it can't happen, but in all the time we've been walking the market, it's extremely rare, and I don't even know if I remember a time when we've had a lasting all-time high or low made in the extended hours trading. I said, what were the first parts of those questions, please?
You said that big money takes a position 2 to 3 days before a
Oh,
big report or event. How does
no,
this
that's not.
reflect in tempo?
No, that's not what I said. I said if the larger money is going to adjust their positions ahead of some important trading number, they generally will do it at least 2 days ahead of time, simply because the day before the markets are too thin. There's not enough liquidity in there. So they generally don't wait till the last minute. And I'm not predicting that they will or won't. I'm just saying if they decide to adjust their position ahead of a big number, they generally will make sure that they've made whatever adjustments they want to make. Now, remember that can be investment money. So many times people don't appreciate the long-term, really long-term investment money. They may not do anything. So that's one extreme. Then you got the other extreme, which is the very short-term day traders. But in between that, there's many different types of accounts. There's hedge funds, there's family offices, there's large independent trading pools of capital, some of them very highly leveraged. And generally when I'm talking about those accounts that are in between the very short term and the very long term, those accounts that are more trading oriented and they can be very large size, are the ones that will generally make their adjustments at least a couple of days prior to any major number, if they're going to adjust. Okay.
Okay. Another question. Even if this is short-term weak hands controlling the market, do we apply the same balance rules for our bracket since December 3rd?
I don't, I look at the market just very mechanical. And I don't, I don't build any exacting levels. I take it what is in front of me right now. If you look what I wrote last weekend, I'm looking at this, the line going up, and I'm saying, if you're going to be a successful short-term trader, you have to understand what other short-term traders are doing. You have to understand that they're very fickle and they will all run very quickly. So right now, if we did, for example, if the market was right here within this 1, 2, 3, 4, 5, 6 day balance, then I would be looking for coming out of that balance. So in this case, it broke to the downside from that balance. Here it broke to the upside, here it broke to the downside, then it balanced again and then broke to the upside. But then when it broke to the upside, you got this, very mechanical trend line. So what I'm looking for there, I said, okay, this is what they're doing. And if their behavior changes, then more than likely, if the behavior doesn't change, then they'll keep going up. If the behavior changes, then you're going to get liquidation, because these are all, very short-term traders. And like I said, they're very herd oriented. So if you had a 4-day balance, I'd follow the 4-day balance, balanced trading guidelines. This is a different time. This is different. It's a trend line, and you get a break from the trend line. Again, too many times people are trying to make the markets too mechanical rather than having a deeper understanding Who is their competition? So right now, who is your competition? Right now, your competition is almost all very short-term traders. Longer-term traders don't, or investors, they don't buy based on an exacting trend line. This is the activity of very short-term traders. So you have to understand who you're competing against, understand that their behavior is going to be much different than all of a sudden if you've got good, solid investment money coming in or coming out of the market. But constantly understand. I mean, it's like watching these football games. You can watch two games on Sunday and both have different offensive plans, have different defensive plans, and you have to understand what the other one is doing in order to have a chance to be successful. And that's what it takes as a short-term trader. You have to understand what your competition is doing. Example, yesterday they got them too short. Going into yesterday, the herd got them too short. Then they got them too long yesterday. And then we got liquidation, overnight. It's just, it's very difficult. So many times traders are trying to make it scientific, trying to be scientific about the trading, or they're trying to look for exact references. And you have to have a deeper understanding, I think, of what is really going on in the market's continuous two-way auction process. The more the market is oriented with short-term traders, the greater the odds that you're going to have this constant adjustment of inventory getting too long, inventory getting too short, inventory getting too long, inventory getting too short. Because so many traders do know nothing more other than to follow what everybody else is doing. Okay, what else?
Okay. There are many market commentators currently talking about how year-end rallies are so common because structured products and the associated hedges cause dealers to buy stock and indices as a result of those hedges nearing expiration. These same commentators further discuss that these rallies are frequently followed by substantial declines sometime between late January through mid-February, as these dealers then reposition again. Does Jim consider how dealers are likely positioned to help with his market analysis?
Absolutely not. Number one, I'm not smart enough to understand all that, and there's all kind of people that write about it as if they understand it. I'm not sure that they really do. I'm a short-term trader. I look and I say, what is going on in the market right now, today? And I'm very careful not to get myself entangled in a lot of the other commentary that's out there. It may sound crazy. I know a lot of people, they'd love to hear and read those things. More importantly, as a short-term, keep in mind, I'm a short-term trader. So much of short-term trading is dependent upon inventory getting too long and too short. And here's a constant example of it. The market they broke the trend line, it got too short. Market got too long. Now the market's short. Who knows what it's going to do today? I mean, you're right in the middle of all of that. So many times people are trying to understand. If you're a long-term trader, you look at it differently. Intermediate trader, differently. If you're a short-term trader, which is what I am, your constant focus is on short-term inventory. And then you're always looking, okay, so what we had for 10 days, we had the trend line. What was the market doing? They were buying, short-term traders were buying that trend line exactly for 10 days. That's what the market was doing. If you have some other ideas, guess what? The market didn't care. That's what it was doing. And then when it broke down, could I see, as I put out last weekend, higher prices were bringing in lower volume? That is not a good sign. That says the risk was high. Well, all of a sudden the market broke and you got this tremendous liquidation and everybody went from one extreme to the other. Then they took it all the way back up, yesterday. And now, you're right in the middle of the last couple of days. People make trading much more difficult than it has to be. And they're constantly looking for, some magic secret, and the magic secret is understanding what your competition is doing. Okay, what else?
Okay. Goldman Sachs and Morgan Stanley make $50 million a day. They pretty much control the market with the liquidity that they control. Would you say that short-term trading is at their mercy?
They're different. They're different markets. They're different markets. You know, sometimes you can benefit from that. Sometimes they take your money. I mean, a lot of what they do a lot of statistical arbitrage too. You know, when things get out of line. You know, I've done institutional trading in there, and it's, you know, they take advantage. They're not doing pure. Sometimes they do, but they're not generally doing pure specs. There's a lot of relationship trading that goes on in there. Okay, what else?
Okay. Does it take time to learn the behavior of who you are competing against?
Of course it does. You know, it takes a lifetime, and it changes. It constantly changes. And it's just like an offense or a defense in football. They constantly change in order to make it difficult for the competition. And it constantly changes, and you have to be adept. You have to be adept at being able to read it and understand it. So many times people are looking for exacting references to trade the market. And that's going to make it very difficult. You're not going to really understand what your competition is doing by trying to be that mechanical. You have to be involved in it. I'm doing we're going to do a program next year. We don't know when yet, but I'm putting pieces together. But the first part of the outline for that program says that, and I don't remember, I've got the words exact in there, but it said successful trading requires that you are at a level that is, your intuition is above anything that is available from classroom learning. Classroom learning may give you the basics, but it's the real competition comes when you have a greater intuitive understanding of what is going on in the market, and you can move much quicker in the market. You're not going to learn it in a classroom. You're only going to learn it by being involved in the market and involved on a very deep level. Okay, so the market is open. We're open right at the point of control from overnight. Very mechanical again, right? It traded there, I don't know, 20 some times there overnight. I don't know how wide that is. So that's the market's done. It's right in the middle of the overnight trade. We're within yesterday's range in here. Okay, I mean, this is late in the year. You're not going to get a lot of new money coming into this market or leaving this market. You're going to get an awful lot of short-term traders back and forth in the market. Okay, final question or two.
Okay. Question about your new book. What kind of benefit will we get from this one that we cannot find in your first two books?
Oh, I can't answer that. I don't know what anybody's going to get out of it. I mean, this book has got substantially more on the self-understanding portion and how much the mental part of trading, far more than the earlier books. Okay.
Okay. I would say it also had, yeah, as somebody mentioned here, 20 more years of experience in there. But I would also say that in terms of things that you're focused on and things that you are mentioning that are, like momentum, like where momentum has its place and how that's the leading indicator, or rather than yeah.
Well, the real point is if you think about the book, what we really do, momentum clearly the most important factor in the market is momentum. What we try and do is put context around momentum. So many people don't do that. They just simply look at price momentum, and there's no depth to that. By using the way we organize the market, we're trying to put momentum within the context. And I think that's a huge, huge difference. That differentiates us from what most people do. Okay, final question?
I think that we're good. So I did put the link in the GoToWebinar chat for those of some folks asking that, but you can also go to our website, go to jimdaltontrading.com and go to resources at the top navigation and go to books, and you'll see Jim's book featured up there at the top. It was also, the link to it was also included, not in this morning's email, but the email that was sent out 2 days ago to announce this webinar. The link was in there too. And I'm sure we will definitely include it in future emails as well. Like I said, if you are not subscribed already, you can sign up on our homepage at jimdaltontrading.com, and also be sure that you confirm that you want to subscribe, because you're not subscribed until you respond to that, to the confirmation email. Okay. Oh, and some folks chimed in and said UK, they were able to pre-order the book there. So thank you very much for letting us know that. If you live in another country and you're also able to pre-order the book, let us know.
Thanks.
Okay. Thank you so much.
Let me say one thing before we go. As a short-term trader, until you're going to have to develop your intuition in order to be competitive, in my opinion. The best source that I have for that is a book called Incognito by David Eagleman. It's not an easy read, but it is a start to understand intuition and how the mind works. Anyhow, thank you very much. Have a great holiday. Bye now.
Thank you, everybody. Stay tuned to your emails for any more things related to the book and more public webinars, and as well as live programs that we'll be doing next year. Thank you so much for joining us today. Take care. Stay safe. Bye-bye.